Hello everyone. I've searched for this kind of video online but I couldn't find it anywhere, so I decided to make mine. I want to show you in real life how a candlestick is being formed. So this is going to be live demonstration. Currently I'm on MT5 on my PC. I've installed a timer here. This is just an indicator. So if you want to install a timer on your MT5 or MT4, whatever, you need an indicator for that. It doesn't come with MT5, so I did this myself. So back to what I want to show you today: the open, the close, and the wick of a candlestick. So what I want to do now, I want to get rid of every other thing that can cause distraction. Okay, so look at the time. When this time gets to 0, this candlestick formation will close. From 24 seconds downwards, so this candlestick will continue to go up and down like this until this time finishes. Watch. 2, 1, reset again. Now a new candle begins to form. Now if you look very well, this is the open of the candlestick, meaning when this candlestick closed, this was the first impact on this candlestick. So that first impact is the open, and as long as this time is still counting, this candle will continue to form until this countdown finishes. So you can see that the open is very unique. Now the time I've reset again. Now a new candle has begun to form. This time around, this is the open of this candle. Let me get rid of the previous one so that don't get confused. So this is the open of this particular candle, and this candle will continue to go up and down until this time finishes and reset to 1 minute. So what is happening here? The time frame selected has something to do with the duration at which the candlestick is going to form. If you select 1 minute, as we have done right now, it means each of this candlestick is 1 minute, as in it took them 1 minute to form. Okay, look at the time. It says 4 seconds, 3, 2, reset. Another candle starts from here. So each time this timer finishes, a new candle begins to form. Why is that? Because each of these candles is going to take 1 minute to form one of these candles. That is exactly the relationship between time frame and candlestick. From then we move to the next aspect I want to talk about today, and that is the body of a candlestick, open and close, and the wick. So I believe you now know why time frame and the candlestick, they are the same, because each time frame you are currently on determines the time or duration it took to form one candlestick. Now let's go to what we call close, open, and wick. For this, I would like to use a higher time frame. So right now I'm on 15 minutes time frame. So the implication of that is it took each of these candlestick 15 minutes to form. This one here forming now has been forming for the past 5 minutes. In the next 15 minutes, this candle will be done, and the formation will move to the right of this candlestick. Now, to the most important aspect of this video. You can see that some candlesticks are long while some are short, but despite that, they all took the same time to form. Now let's use this one for an example. This top here is the highest point the candle moved during its formation. So this pin here, this pin you're seeing here, is either called the shadow or the wick. And also, this bottom here is the lowest point the candle went to during formation. So this becomes the lower wick or shadow. Then this place here, from here to this place, is the body of the candlestick. Now, what gives the candlestick its color is very simple. The red means a down movement, while the green means an up movement. So when you see a green candlestick like this, it means it's opened below and closes at the top. Now remember, a candlestick must always open before it will close. So when it opens here and moves up, the color becomes green because the open occurs first before the close. But in the case of this red candlestick, from here to here is the body. Now for us to have a red candlestick, it means it's opened here and closes below here. And what is the direction of the movement? Open before close, so the direction is downward. And that's why we're having a red candlestick. It's as simple as that. So what determines the color of a candlestick is the open and the close positions. So let's go to 1 minute and follow this open and close in real life so that we understand what we are talking about. So we are now on 1 minute. You can see we have 21 seconds for this candlestick to form. When this time finishes, this candlestick will stop forming. So if you can look here, this place is the first impact. That was the first impact the candlestick went to when this one closed. So that part, that first of impact, is the open. So for us to find the close of this candlestick, we have to wait till this time finishes before we can get the closing point of this candlestick. So you can see that the candle continue to go up and down, making new highs and making new lows. The highest point is usually noted by the wick. You can see. So this time finishes and a new candle begins to form. So this one closed here and opened here. So this distance between the close and open is what we call the body of the candlestick. That is the body of the candlestick. While this part, which is the wick, is the highest point the candle went to during its formation. And this low wick here or shadow is the lowest point the candle traveled to during its formation. So these are just the way the candlestick is formed. The reason why I decided to break this thing down is because I made a search on the internet to see if I can find any video like this, but I couldn't. So I decided to make one for easy understanding. Now a new candle begins. Here is the first impact. So here becomes the open. As that is the open, let's watch and see where the close is going to be. So here is the first impact, is the open. You can see that when price is above the open, we see a green candlestick. But if this price goes below the open, the color changes to red. The open and the close determines the color of the candlestick. So right now, the timer says 9, 7, 5, 4, 2, 1. Another candlestick opens here. So this one closed here. You can see the price is below the open, we have a red candlestick. If the price goes above the open, we will see a green candlestick. Sorry, with this I believe I've been able to explain to you how a candlestick is formed. Now, one thing you have to know is this. This one is a very long candlestick. It means there are a lot of sellers pushing the price down. That is what it means. That most sellers came into the market now and they're trying to push the market down. Not just trying to push the market down, but they're pushing it with a serious momentum. That's why we have a long red candlestick. When we have a long green candlestick like this, it means more buyers came into the market and they're pushing the market up. Not just pushing the market up, they're pushing the market with a very strong momentum. So I believe with this, I've been able to do justice to candlestick formation.
View FX Academy candlestick pattern every trader should know. What is a Japanese candlestick? A Japanese candlestick is a type of price chart that shows the opening, closing, high and low price points for each given period. It was invented by Japanese rice merchants centuries ago, and popularized among Western traders by a broker called Steve Nissen in the 1990s. Candlestick patterns are used to predict the future direction of price movement. A candlestick is a way of displaying information about an asset's price movement. Candlestick charts are one of the most popular components of technical analysis, enabling traders to interpret price information quickly and from just a few price bars. It has three basic features. The body, which represents the open to close range. The wick, or shadow, that indicates the intraday high and low. The color, which reveals the direction of market movement. A green, or white, body indicates a price increase, while a red, or black, body shows a price decrease. Over time, individual candlesticks form patterns that traders can use to recognize major support and resistance levels. There are a great many candlestick patterns that indicate an opportunity within a market. Some provide insight into the balance between buying and selling pressures, while others identify continuation patterns or market indecision. How to read Japanese candlestick patterns. To read Japanese candlestick patterns, you'll need to familiarize yourself with three elements on each candle: its color, its body, and its wick. Its color tells you the direction of movement within the period, its body displays the market's opening and closing levels, and its wick shows the high/low range. On most charts today, green candlesticks indicate upward movement and red ones a move down. However, occasionally white, up, and black, down, is used instead. On a green candle, the top of the body is the close and the bottom is the open. On a red one, the opposite is true. On both red and green sticks, the top of the wick, sometimes called the shadow, is the highest point that the market has hit within the period, and the bottom is the lowest. Using those three elements, you can learn a lot about a market's movement within a particular period. A long body on a green candlestick, for example, tells you that significant bullish price action occurred. If the wick is even taller than a long body, it shows that there was a high level of volatility within the period. So, bulls and bears may have been vying for control, with bulls eventually winning out. A short red body with a high upper wick, meanwhile, indicates that bulls pushed the market's price higher, but were beaten back by bears before close. And if there's no wick at all, you know that the open or closing price was also the high/low. Some patterns are taken as indications of probable future movement by technical traders. The theory here is straightforward. These patterns reveal particular behavior that has often led to specific outcomes in the past. There are three types of candlestick pattern: single, double and triple. This is based on the number of sticks that make up the pattern. While past performance is no guarantee of future price movement, these patterns can be useful when spotting opportunities. Let's take a look at some popular examples. Single candlestick patterns. These are some of the simplest patterns you can find, comprising just one trading period. Often, they form the building blocks of longer patterns. Maribozu. Maribozu comes from the Japanese word for bald. It means a candlestick that has no wick whatsoever. A green Maribozu opened and closed at its lowest and highest levels respectively. A red Maribozu opened and closed at its highest and lowest levels respectively. If we visualize the movement within a green Maribozu, there'd be no price action above or below the open and close prices. As you can see, this makes a bald green stick an indication of clear bullish sentiment. Bulls pushed the market's price higher with little fight back from bears. If this occurs as part of an uptrend, technical traders see it as a sign that the upward movement will continue. If it happens after a downtrend, a reversal may be on the cards. Red Maribozu, meanwhile, are the exact opposite. They tell you that bears were in almost total control of a session, and therefore that a downtrend could continue or an uptrend may reverse. Doji. When a market's open and close are almost at the same price point, the candlestick resembles a cross or plus sign. Traders should look out for a short to non-existent body, with wicks of varying length. This doji's pattern conveys a struggle between buyers and sellers that results in no net gain for either side. Alone a doji is neutral signal, but it can be found in reversal patterns such as the bullish morning star and bearish evening star. In a doji pattern, the open and close prices are exactly equal, or almost exactly equal. So, the body appears as a very thin line, typically less than 5% of the total range of the period. Like spinning tops, this can tell you that the bulls and bears have cancelled each other out by the end of the session. There are four main types of doji to watch out for. Long-legged doji have a lengthy wick both above and below the body. Gravestone doji have a high wick above the body and nothing underneath. Dragonfly doji have a long wick beneath the body and little to no wick above it. Four-price doji have no wick at all. Doji are often taken as an indication of an upcoming reversal. If a market forms after an extensive uptrend, then it may be about to head back down. After a bear move, selling sentiment could be exhausted, meaning bulls are about to take over. Hammer. The hammer candlestick pattern is formed of a short body with a long lower wick, and is found at the bottom of a downward trend. A hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market than red hammers. Inverse hammer. A similarly bullish pattern is the inverted hammer. The only difference being that the upper wick is long, while the lower wick is short. It indicates a buying pressure, followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that buyers will soon have control of the market. Shooting star. The shooting star is the same shape as the inverted hammer, but is formed in an uptrend. It has a small lower body, and a long upper wick. Usually, the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground. In a shooting star, the session starts with the bulls still in control. But bears take over, dragging the asset's price back down. In a green shooting star, they pulled it back to just above the open. In a red shooting star, they pulled it down below the open. Both indicate that a reversal may be imminent. But like the hammer, inverted hammer and hanging man, it's often a good idea to wait for signs of a new bear market before trading. Hanging man. The hanging man is the bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. It indicates that there was a significant sell-off during the day, but that buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. Spinning tops. The spinning top candlestick pattern has a short body centered between wicks of equal length. The pattern indicates indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher, while the bears pushed it low again. Spinning tops are often interpreted as a period of consolidation, or rest, following a significant uptrend or downtrend. On its own, the spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come, as it signifies that the current market pressure is losing control. The spinning top candlestick pattern forms part of the vast Japanese candlestick repertoire with its own distinct features. Often associated with indecision in the market, spinning top candles can provide valuable supporting information to a trading strategy. When a signal is formed from two consecutive periods, it's known as a double candlestick pattern. These often hint at upcoming trend reversals, but can also be used to identify continuations. Bullish engulfing. The bullish engulfing pattern is formed of two candlesticks. The first candle is a short red body that is completely engulfed by a larger green candle. Though the second day opens lower than the first, the bullish market pushes the price up, culminating in an obvious win for buyers. A bearish engulfing arises when a bullish stick is then swallowed by a subsequent bearish one. So negative opinion may be forming. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle. It signifies a peak or slowdown of price movement, and is a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. Piercing line. The piercing line is also a two-stick pattern, made up of a long red candle, followed by a long green candle. There is usually a significant gap down between the first candlestick's closing price, and the green candlestick's opening. It indicates a strong buying pressure, as the price is pushed up to or above the mid-price of the previous day. Dark cloud. The dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over the previous day's optimism. It comprises two candlesticks, a red candlestick which opens above the previous green body, and closes below its midpoint. It signals that the bears have taken over the session, pushing the price sharply lower. If the wicks of the candles are short, it suggests that the downtrend was extremely decisive. Harami. A harami is essentially a backwards engulfing pattern. A candlestick is followed by a much smaller one in the opposite direction. The name harami comes from the Japanese for pregnant, because some believe that the pattern resembles a pregnant person. In a bullish harami, a red candlestick is followed by a green one that is completely contained within the body of the previous candle. This is often taken as a sign that a downtrend may be ending. In a bearish harami, the opposite happens, a green candle followed by a smaller red one. In both cases, the size of the second stick is used to determine the strength of the signal, the smaller the better. If a harami is followed by a doji, the smallest possible candle body, then it's known as a harami cross. Tweezers. Tweezer patterns are two candlestick reversal patterns. This type of candlestick pattern is usually spotted after an extended uptrend or downtrend, indicating that a reversal will soon occur. In a tweezers pattern, two identical candlesticks in opposite directions appear after a bull or bear market. Tweezers are taken as a sign of an upcoming reversal. The second candle is the opposite color, but otherwise identical. So together, the two looks like a pair of tweezers. There are two types of tweezer patterns, the tweezer bottom and the tweezer top. The most effective tweezers have the following characteristics. The first candlestick is the same as the overall trend. If the price is moving up, then the first candle should be bullish. The second candlestick is opposite the overall trend. If the price is moving up, then the second candle should be bearish. The shadows of the candlesticks should be of equal, or near equal, length. Tweezer tops should have the same highs, while tweezer bottoms should have the same lows. Railroad track pattern. One of the best and most reliable candlestick patterns is the railroad track candlestick pattern. It is formed by two opposite candles. In this pattern, both the candles are similar in design, but one must bullish and other bearish. Below is the representation of a railroad track pattern. Since this pattern looks very identical to a railway track, it is given the name railway track candlestick pattern. Types of railway track patterns. There are two types of railway track pattern, namely, bullish railway track and bearish railway track. Bearish railway track pattern. In this pattern, the first candle is bullish, and the second candle is bearish. If we try reading the pattern, the market showed bullishness in the beginning but came right back down in the end. Bullish railway track pattern. This pattern is opposite to the bearish railway track pattern. Here, the first candle is bearish, and the second candle is bullish. Triple candlestick patterns. The longest patterns we'll cover in this article are triples, which are made across 3 consecutive periods. Triple candlestick patterns are often seen as some of the strongest signals of an upcoming move. Morning star. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a 3-stick pattern, one short-bodied candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies, as the market gaps both on open and close. It signals that the selling pressure of the first day is subsiding, and a bull market is on the horizon. A morning star plays out as a market hits a point of indecision after an extended downward movement, then begins to recover. It consists of 3 candlesticks. A red one with a large body, which is part of the downtrend. A candle with a short body, often a spinning top, indicating that bulls are entering into the session. A green stick with a tall body confirming that a reversal has begun. Traders may take this as a sign that the recovery will turn into a lasting uptrend. Evening star. The evening star is a 3-candlestick pattern that is the equivalent of the bullish morning star. It is formed of a short candle sandwiched between a long green candle and a large red candlestick. It indicates the reversal of an uptrend, and is particularly strong when the third candlestick erases the gains of the first candle. An evening star is the opposite of a morning star, showing a bull market that hits a point of indecision and then begins to retrace. It looks the same as a morning star, but with a green candle at the beginning, after an extended uptrend, and a red one at the end. Both evening and morning stars can be formed with a doji in the middle. This indicates a stronger period of indecision, and is sometimes taken as a sign that the subsequent move will be more pronounced. 3 white soldiers. It consists of consecutive long green, or white, candles with small wicks, which open and close progressively higher than the previous day. It is a very strong bullish signal that occurs after a downtrend, and shows a steady advance of buying pressure. The 3 white soldiers pattern appears after an extended downtrend and small consolidation. Technical traders use it as one of the clearest signs that the bear market is over. The 3 soldiers are: a green candle after a downward move, another green candle, with a bigger body than the first and little to no upper wick, a third green candle, with a body that at least matches the second and little to no wick whatsoever. 3 black crows. The 3 black crows pattern is the opposite of the 3 white soldiers. It appears after an uptrend, consists of 3 consecutively longer red candles and is taken as a strong signal that the bull market is over. The second candle should have a short or non-existent lower wick, and the third should have close to no wick at all. A technical trader may take the 3 black crows as an opportunity to open a short position to attempt to profit from the following bear run. 3 inside up. The 3 inside up pattern is another trend reversal indicator, appearing after a downtrend and signaling the beginning of a potential reversal. The three candles in an inside-up pattern are: a substantial red one that continues the previous downtrend, a green stick with a body that closes at least halfway up the previous candles, so the market has recovered half of the last period's losses, a green candle that closes above the high of the first one. Buyers should now have overpowered sellers, arresting the market's decline and possibly kicking off a new bull trend. 3 inside down. The 3 inside down is a reversed inside up. It consists of a long green candle, followed by a red candle that closes at least halfway down the one before. Then another red candlestick that closes below the low set by the first. When a 3 inside down appears after a bull market, traders who watch for patterns might see an opportunity for a profitable short position. Falling 3 methods. 3-method formation patterns are used to predict the continuation of a current trend, be it bearish or bullish. The bearish pattern is called the falling 3 methods. It is formed of a long red body, followed by 3 small green bodies, and another red body. The green candles are all contained within the range of the bearish bodies. It shows traders that the bulls do not have enough strength to reverse the trend. Rising 3 methods. The opposite is true for the bullish pattern, called the rising 3 methods candlestick pattern. It comprises of 3 short reds sandwiched within the range of 2 long greens. The pattern shows traders that, despite some selling pressure, buyers are retaining control of the market. Japanese candlestick summary. Japanese candlestick charts enable you to analyze price action at a glance. Technical traders might use them to spot upcoming trends, reversals, and continuations. There are 3 main types of pattern: single, double and triple.